most people invest where it's easy, where money flows, people go, right? We don't realize what type of challenges create new opportunities. So I think the message is California sucks to be a business owner and a real estate investor. And that message resonates, really dependent on your political view. And then a lot of people just don't bother with the state. I typically try to look for the areas that everyone's running from. And that's usually where I want to go. I believe that there's a greater opportunity when you do that.
Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things finance and real estate. And my guest today is Mikey Taylor, retired professional skateboarder from LA. And he is actually one of the different kind of investors that actually invest in California. A lot of the people that we meet, typically everyone says do not invest in California. So we want to talk about how it is to invest in California, particularly in commercial real estate, multifamily self-storage units in California. Mikey is also the host of Life with Mikey podcast, co-founder of St. Archer Brewery, and also the co-founder of Commune Capital. And as I just found out, you're actually also on the city council of the city you live in. So with that said, first of all, welcome, Mikey.
Thanks for having me. Great to see you.
I'm excited to have you here. So first of all, tell us a little bit about you, and then we'll take it from there and we go straight into the subject matter that we want to cover.
Okay. So for me, I started off skateboarding as a kid, fell in love with it, didn't want to stop. So I figured out a way to get companies to give me free product that eventually turned into them paying me and a full-blown professional skateboard career. I did that for about 14 years, which was 10 years longer than I was expecting to do it for. From there, I started my first business, which was called St. Archer. It was a craft brewery in San Diego, California. We sold that company to Coors in 2015. And then from there, I started my current business, which is Commune Capital, a private equity real estate firm, where we build storage units and apartment buildings. We bring investors in to real estate who don't want to do the work of managing assets, but would like to see a return in alternative investments. And then last, I got this wild idea that I should get involved locally in the area that I grew up in and currently live. So I decided I would run for city council back in 2022. Had no experience in local politics, never thought I'd have a desire in doing it, but went for it and ended up getting elected in November. So I've just finished my first term, or not my first term, my first year of a 4-year term. So I have 3 more years to go.
Woohoo! So you're going to go run again afterwards, or is that 4 years enough?
I don't know yet. I kind of going into this, I decided if I feel like I can make an impact and I'm actually getting stuff done, that I would run again. And so probably at year 3, I'll look around and make that decision.
Makes sense. Now, I mean, it's definitely particularly as a developer, and if you develop locally, it's definitely a good idea to be involved in politics. But at the same time, as an entrepreneur, it's even a better idea because you can actually bring some sanity to bureaucracy. It's like I'm a little bit allergic to bureaucracy, but hey, we live in a bureaucratic world. So thank you for probably adding some sanity to that.
I appreciate that. Thank you.
All right, so now let's jump right into it. Like literally every person I talk to that's invests in multifamily or self-storage, self-storage not that much, but multifamily basically says stick to the red states where you can evict people if necessary faster, where you have where you don't deal with all this different kind of things. Like for example, we just last week closed on 91 units multifamily property in Fort Worth, Texas, and in Texas, if somebody doesn't pay the rent by the 25th of the month, they're out the door with literally the police or the sheriff coming and moving the furniture out the door and onto the sidewalk. So how does that compare to California, first of all? And what is your reasoning behind investing in California out of all places, even though prices are sky high, cash flow might not be strong? These are all the stereotypes that I'm going to throw at you right now, and I want to see what you say to them. Prices are high, cash flow is low, you can't evict people, government is horribly pro renters, et cetera, et cetera, et cetera. So give it to me. What do you got?
Okay, so we have a thesis that the government or the managing body of California makes it so difficult to build anything that they have artificially made our market undersupplied. So California, I mean, when you look at economies, we're what, the fourth largest economy if we were a country in the entire world. It's a massive, massive market here. There's a lot of demand. And so when you have that type of demand and a government that makes it very difficult to build, our market becomes off kilted. It's demand up here and supply down here. And so we believe that the state makes it so undesirable for other investors that the state keeps our competition out for us. And when competition is out and the market is undersupplied, that drives your rents up, that drives your values up. So you kind of touched on the point that there's not a lot of cash flow and valuations are really high. Well, we think valuations are really high because there's just not enough product and too many people are bidding on a limited supply. And second, we build. So we don't buy stabilized or existing assets. We buy distressed assets that we can get at a discount. And then we build it to what we refer to as our yield on cost, or maybe you could think of it as we're building it to a better cap rate than the market currently offers. And so we end up getting pretty good cash flow. But yeah, I guess we have the outlook that the government is so bad at doing this that they keep anyone who owns real estate in California's prices up.
Well, that's certainly that. I will agree with that. They're doing a tremendous job at that, California, at basically making it so difficult and keeping the reputation of California for real estate investors so low and so bad that nobody wants to move there. So there's a good point, and that's a really cool contrarian move there. Having said that, are you not concerned about the tenants that stay forever and that you can't evict, or how are you protecting yourself from that aspect?
Yeah, so I'll start by saying we've owned real estate here for a long, long time. And we have never been in a scenario where somebody has stopped paying us and they've ended up having a free place to live for 2, 3, 4 years. We've never experienced that. So, one thing that is important to note that when you develop in California, you have a little bit more flexibility on where rents are going to land. Where it's harder for investors is maybe those that do value add syndications or value add kind of opportunities where they buy something that has rents below market and then they renovate them and then they try to drive rents up. That is more difficult in our state. So there's definitely that. I would say Texas is actually a good example. Idaho is a good example. There's markets that are very easy to develop. And when markets are easy to develop, you see the typical developer cycle, which is there's more demand than supply. So developers come in and build. We overbuild. That's what we do. And once you overbuild, all of a sudden you struggle to lease up. So then you start giving concessions and then discounted rents. And then all of a sudden, the cost no longer makes sense to rent, the cost no longer makes sense to build. And then you see the market correct. That's the typical cycle. In California, it just doesn't happen. They don't allow the market to ever get to that point of oversaturation. And so we don't see it basically correct the way it should. I would say we should have seen that a year ago, the way you're starting to see in Austin, where prices are correcting. You should have seen that with the way interest rates moved. The only reason it didn't is because we're, as of right now, 2 million units short in the state. So I think it comes down to this. When you're a policymaker, a lot of times they look at trying to solve one problem and they don't look at what the additional effects will be to that policy change. And then they end up in a lot of cases building or creating a bigger challenge than they had leading up to it. So right now in LA County, LA City, you have the mansion tax, right? So they started giving an additional tax for anything you sell over $5 million of value. And they're doing that so that they can then take that tax and build housing for the homeless, right? Well, what they don't realize is by doing that, you're now limiting the amount of transactions. And when you limit the amount of transactions, or you limit the people that want to develop, you're only putting a more significant supply constraint into the market. And so they're inadvertently continuously making real estate investors wealthy. It's insane. Their policies are directed towards the renter, and all they do is make owners wealthy.
So in that case, what did that lead to? Let's talk about that. So you the wealth tax. How large is the wealth tax on and it is on single families or on multifamily too?
It's multifamily as well.
Okay. So anyone that sells anything over $5 million pays how much in tax?
I think it's an extra 4%, I believe.
Okay. So and what that has led to, that people just don't sell?
It's led to people basically not selling, and it's led to more and more investors not wanting to build new real estate here, or at least in LA City. Now, the state of California is a lot larger than LA City.
Sure,
LA City's arguably the most progressive city with San Francisco that kind of exists in the state. But yeah, they have made it so I don't think they're going to catch up to demand now.
Okay. So, and as a result, basically what is in the market has only become more valuable, not necessarily to cash out on, but you can always, because of that, go and actually borrow money out of it and keep your property, just keep borrowing against it and just keep it, which is what the wealthy to some degree already do anyway.
Right. Correct.
Right. Okay, cool. So you said you're more in control of where the rent's going to land because you're building. And that makes sense. But I just want to make sure that for those who are perhaps listening or watching and not familiar with particularly the rules in California, which includes me, is that what you're basically saying that is if you're building brand new, you can set the rents wherever you want them as long as you can get them. There's no restriction. You don't have to follow any kind of law that it needs to be within a certain dollar amount of average rent or things like that. You can, to some degree, say like, hey, I want to charge $5,000 a unit. I charge $5,000 a unit. If you buy existing properties that are renting at $1,000 or $2,000 a unit, you can't just randomly increase them to $5,000 a unit because there's laws in place that allow like rent control and renting kind of. Is it rent control or is it kind of limited rent control or is it?
Yeah, there's rent control, and then there's certain markets that have, different regulation on that. But basically you're capped on how much you can increase rents each year. And then in certain markets, you're capped on basically setting the new rent. So if somebody comes in to a, older Class C property and somebody leaves, and all of a sudden they renovate the whole unit and try to double the rents. In some markets, they don't let you do that anymore.
Okay. And that makes sense. So in that case, it is absolutely what you guys are doing makes total sense. Now, the third reason I think it makes sense what you're doing is in this particular configuration is that you're not building Class C properties. You're building because from what I can tell, what kind of experience is that the people that are becoming the squatters and that stay in these properties for a long time are the people who are gaming the system, and that's typically not the one that can afford a $5,000 a month unit. That's typically not the ones that can afford the Class A unit and then drive up with their Mercedes, have a good paying job. And those kind of people, they care about their credit. They care about their credit worthiness and whether or not they're being evicted or not and things like that. So by being in that market, you're doing the smart thing, which is to go to the Class A property, Class A tenant, where probably as you mentioned, these eviction kind of issues just simply don't exist, right?
Right. You see honestly, you see the eviction or the people that really understand the law. You see that more at play with like slumlords. It's like the person that bought an asset, never took care of it, didn't really raise rent. It was more of like the old school philosophy, which was just make sure no one ever leaves and I'm good. And so it's created a scenario where people's rent is so far below actual market value. And then once somebody comes in to buy it, seeing that, the income coming in from the asset has room for them to raise rents, that's typically the ones that have a hard time in the eviction process. It's new investors that come in that try to do a value add, and the old tenants paying such a discounted rent understand the laws and then basically have a huge price tag to remove them.
Okay. And that again, that makes sense. So this is, again, it's a good example of how to not stereotype just one state across the board, because within the states, there's different kind of games that you can play and different kind of models you can pursue. And to be honest, this makes sense. This makes sense. I mean, going into a California market where mentioned 2 million units lack of like there's underbuilt by 2 million units, where it makes it harder and harder to build, and going in there and going to the extra effort to actually build, and then being able to build a Class A space that has tremendous valuation that you can actually get market rents for, is actually a very, very smart thing to do. So congratulations, that's well thought out, man. And that's well thought out. So with that said, how does it apply to self-storage? Self-storage typically doesn't have, since it's by definition a little bit more commercial use, doesn't have the same kind of issues in the first place. And is it also hard to build self-storage there? Is it hard to build anything in California? Again, I've kept my hands off California entirely, apparently for the wrong reasons, but enlighten us.
Well, I'll tell you this. Look, most people invest where it's easy, right? Where money flows, people go, right? The idea, more or less, is that we don't realize what type of challenges create new opportunities. So I think, it's just the message is California sucks to be a business owner and a real estate investor, and that message resonates, really dependent on your political view. And then a lot of people just don't bother with the state. I typically try to look for the areas that everyone's running from, and that's usually where I want to go. I believe that there's a greater opportunity when you do that, but that is just for our apartment portfolio. Our storage, we have one asset in California, and then everything else is outside of the state. Our model for storage is actually very difficult to do in one area, which is we do a retail kind of conversion to storage. It's called adaptive reuse. So we buy Walmarts, Kmarts, Bed Bath & Beyonds that go vacant, and then we basically fill the inside with storage units. So it's difficult to do in, maybe a hyper-focused market because cities don't typically like storage, and they don't like you repurposing what was a Kmart and converting that into now a CubeSmart or a Life Storage, et cetera. So our storage platform is all over the nation.
Okay. And that is another kind of cool niche game, because a lot of these Bed Bath & Beyonds obviously have gone away. Well, Kmarts are gone by now. Is there any Kmarts left? I don't know if there's any.
I don't know if there's any left either.
But these properties still sit there. Now, that's another good way of going about that. Now, do you find that specific parts of a city are more okay to go? I'm thinking about where I live, just up the road. It's a nice four-way intersection. On the one end is a place where there was a Bed Bath & Beyond. And I think, that the community and the city council would scream out loud if somebody wants to put a storage in there, because it is still in itself a pretty lively local neighborhood. It's a pretty lively, actually, commercial development. There's restaurants and there's bars and restaurants and things in there. It's just that there's one or two of the anchor stores are just dead now. So that's not typically probably where you guys go. You probably go into the little bit more empty ones. Is that safe to say, or am I just speculating?
Yeah, it's a really good point. So anytime I talk about how we convert vacant big box retail to storage, my DMs are flooded with, hey, there's a Kmart down the street from me that's been vacant for a year. The challenge is not finding vacant retail. That's everywhere. I mean, you just look what's going on with malls, especially. The challenge is you have to find one that the city has been trying to figure out what to do with it for a certain amount of time before you even get them to the point of allowing you to rezone it. So if you're a city council member, they're first and foremost going to think about, how do they put a new need in for the community, and how do they create jobs and bring in revenue from sales tax, right? The economy and living are the two big ones. And so when you have a footprint like, let's say, a Bed Bath & Beyond that had maybe, 85 employees, which was at the heart of the center, it was good for the economy, it brought in revenue, they want to put a new operator to take in that space. That's the first thing they're looking at. And it usually takes a city a long time till they realize no one's going in there. And once they don't, then you could start looking at your options. I would say right now, most cities are looking at how to convert these opportunities into apartments. Housing is kind of the number one focal point for a lot of areas. But what we found by doing this for so long, that we have enough basically examples of taking these things full cycle that we can go to a city and show them This is what we do with them. These are the before and afters. This is how it's benefited the city. And we end up getting a handful that will say yes, but it's the minority. The majority of cities will not allow us to do this.
Other than providing more revenue again, how does it benefit the city?
So think of it this way. When you are in the managing body of a city, the aesthetic and the basically feel that people have living in the community is a big deal. Perception is a lot, right? And when you have a vacant asset, especially when windows start getting broken that aren't getting fixed, the parking lot has all the weeds growing out of it, that is typically an indicator that your city is heading in a bad direction. And so when you can basically take what was that focal point of this city is in distress and all of a sudden repurpose it where it looks very nice now, streets are paved, it's an asset that is now performing, that typically brings in a new kind of, how would you say this, resurgence of the community to think that everything is on the up and up as opposed to everything being on the decline.
Yeah, that makes sense. Very cool. Like I like this. This is definitely different thinking. Now, I pride myself in being a contrarian, but I hadn't thought about these kind of things. I guess I'm too busy with what we do right now. But there's some really interesting thoughts here about how to look at existing real estate in different ways, how to look at states in different ways, and I really enjoy that. So what keeps you excited? What has you excited these days the most?
Oh man, I would say I have 4 kids now, ranging from 11 to 1. And so they're keeping me busy on just, for my wife and I trying to build them up to be kind of the next leaders of their generation. I would say on the real estate side, this is the last big opportunity that I was a part of with real estate was 2008. It was the financial crisis. Mm-hmm. And I was not at the point where I could really go after all the opportunity. And so I feel like I've been waiting for one of those moments to hit again. And I believe we're in that moment right now with real estate. I think there's a very unique opportunity that's happening where you have these markets that are so undersupplied. And the idea that you can build something and you're going to lease it up so fast because they can't build enough quick enough, that's a cool opportunity. So I would say, I'm driven right now by capturing as much of this window as I can so that once the market corrects again, I will look back at this and go, man, we got everything we possibly could when it was hot.
Okay. So how long do you think that lasts? I'm assuming you're referring to the apartments in California right now, first of all?
Yeah, so apartments in California, how apartments are valued, as you know, is based on cap rates. Right. And cap rates have moved in California by almost a full percentage point. And that is massive in real estate. Like if you had a $60 million apartment and it dropped a full percentage point in cap rate, now it might be a $47 million project. So that's $13 million of value wiped out. That means you can now buy at a discount. So I like the idea that you can buy at a discount. Finally, I like the idea that assets are distressed and developers need liquidity at a time where most people are pencils down or can't bring in enough equity or qualify for financing to take advantage of what's here. And so that is something that's similar to, let's say, 2009, 2010, 2011. There were deals everywhere. People couldn't get financing. And so they weren't able to go after what the true opportunity was. That's what we're seeing right now. So how long is it going to last? If I were to guess, I would say 2 years. How long I hope it lasts? I mean, gosh, for a long time.
Yeah. No, I 100% agree with you in that. Now, we just bought 91 units, as I mentioned. We got in the Dallas-Fort Worth area where cap rates were really, really low, and we got that thing at a 7.5 cap. And basically, we don't really need to do anything to that asset other than hold it.
Right.
Until the market comes back to sanity, until market comes back to normal. We also estimate about a couple of years. Now, obviously, doing that in these markets, you doing that, the swing could be even bigger because of the undersupply of of properties out there. Now, what do you think about the current office market? Are you playing in that in any shape or form to take that and convert that into anything else, particularly in California, where a lot of the office has gone in shambles and so on? Are you in any shape or form playing or considering that?
Well, I would say when we started seeing what was happening in office, and when I started talking to friends of mine who are brokers in the office space, telling me that the numbers do not reflect how bad it really is, I was excited for sure. The challenge is it's really expensive to repurpose office into, let's say, apartments. And so I'm not sure. I'm not totally sold that we're going to be able to repurpose our way out of this. I'm you've got to, they have to lose so much value that you're basically just buying the land value at that point. And I don't think it's there yet. And I think it's too expensive to repurpose. So my idea is you're probably going to start seeing local governments or even, going a little bit further up, get involved. They're going to have to try to figure out what to do with these things. I mean, I don't know about your market, but here it hasn't corrected at all in comparison to what the vacancy really is. I mean, these things are empty, they're dead, and a lot of banks, local banks, own them. I'm not sure. I'm not sure we even realize how bad it's going to get, but I think office is probably going to be 10 years of disaster is going to be my expectation. I don't think we're getting our way out of this by some short-term fix.
Yeah, so I think Phoenix, where I live, is a little bit in a bubble in itself, not in a value bubble, but like in its own little world, because we're getting so many people moving here every single year that naturally, even though they're not building anything anymore, obviously construction for office has completely stopped. There's the occupancy rate on office is actually pretty good here. Like we're kind of safe as well as with retail. I hear from people coming from other markets to Phoenix and they can't believe how occupied retail is. Well, that's simply a fraction of 75,000 people moving into this market every single year, and they got to go shopping somewhere. I know most of them shop Amazon, but some still shop at the local retail. Some still go to the novel places, and some of them still start offices and need some office space. It's just gotten much more fragmented, much more smaller. I just attended a conference the other day, or like an afternoon conference with a local group I belong to, where they had the office discussion, and they're all saying that they're pretty stable. The large office spaces is what's really killed, but Phoenix doesn't have that much. So we don't have a whole lot of the high rises that are completely empty. They were occupied by one tenant and everyone is at home now, and half or the entire tower stands empty. That is different, particularly in the big cities in California. And that I agree. That is is really, really hard to repurpose those, because what most people don't see is that, and just perhaps to share a little bit, why do you say is it so expensive? I mean, it's from what I understand, it's like converting an office into an apartments is not just putting in walls. There's an office is like one big floor with like one bathroom. But in order to put apartments in there, you got to put 30 bathrooms per floor in, with all that plumbing and all that wastewater and all that air conditioning and all this kind of things. All of that needs to be unitized, almost like needs to be brought into one unit, and it's almost cheaper to rip it all apart and build it all up again.
Yep, you just nailed it. So basically what we try to do I shouldn't say what we try to do. The reason why we repurpose the retail into storage is because we can do it a lot cheaper than if we were to develop it, right? In office, that's not the case. So you just kind of touched on it. It makes more sense to just develop it. And so if you're going to buy an office building with the intention of scraping it and then developing, you need that thing to come at such a crazy discount that I don't think we're there yet. You touched on a couple things there. Office here, I have a friend in office. We were talking about this last week. He was like, I used to have to get to my building at 7 a.m. to be able to park underneath the parking structure. And if I got there by 7:30, I was at the ceiling. It just sucked. He's like, now you can come in whenever you want and have your choice of parking. It is free for the taking. And I asked him, like, how many cars do you think are there in comparison to what was, I don't know, let's say 2019? And he said, I bet you there's 10% of people there right now, which is out of control, right? The retail side, which is interesting that you brought up, we were just at a big conference with uh, institutional investors.
Mhm.
These are your huge funds that are buying. I mean, you're talking, I don't know, billions of AUM, billions and billions of AUM. And their main focus right now is, they touched on multifamily, but they touched on retail. They are really bullish on retail right now. And their outlook was fascinating. It was one, retail's already gone through so many challenging times that it's kind of weeded out the weak retailers. And two, they're noticing this trend happening where, with social media, the big companies were getting a cost of, let's say, their acquisition or customer for so cheap, but they maxed it out at this point. And now they're having a hard time continuing to grow it. And a lot of them are now moving back into retail as a lead generation that's landing at a cheaper rate than what they're paying on social, which I thought was fascinating. I never thought of that in the equation. So I think you're going to continue to see a lot of institutional dollars go into retail. I think you'll continue to see it in multifamily. Office, I don't know. I think it's a lot darker than we realize.
Yeah.
And there's a lot of money tied up. There's a lot of risk in it because there's a lot of banks that hold these properties, as you mentioned. And even if they either hold the properties already because they're already foreclosed on it, or hold really, really bad debt on it. And I think they're almost artificially being propped up right now. And from some of the conversations I've had with people there, said like one of the reasons why banks are currently not lending a whole lot is that there's a chance they're being told by the Fed or so, like, keep some of your powder dry because we're going to have to force you to write off all of that bad debt from office sometime in the future, not necessarily in an election year right now, but sometime afterwards. So there might be some bank failures and other things coming in that space just from the exposure to so much bad debt in the office space. And where do you see, if that's coming, where do you see the opportunity there, if any?
I think we're going to learn a lot after this election cycle. I don't usually hold a lot of weight on what the financial futures will look like because of an election, but I will say what is being communicated as the strength of our economy versus what it feels like, they seem really far off to me. Yeah. So I don't know. We'll see if anything changes once we finish out in November.
You're basically saying the economy is not as strong as it's being portrayed.
I'm saying I would not be surprised if that's the case. And look, I understand the numbers. Like, the numbers look like our economy is doing really well. It's just when I look around and I talk to people and I see what companies in our space are going through, they don't match. It doesn't feel or look like good, happy times. It looks like contraction. Yeah. And so the president's supposed to be, working with the Fed and creating these. No, but I don't know, to say that we haven't seen stuff like this happen on election cycles, especially for an incumbent wanting to get reelected. I'm not going to go there either,
Right. Yeah, absolutely. Yeah, Michelle and I, my wife and I, we always have this unofficial economic barometer, to call it. And that's like, how long does it take to get, how long of anticipation do you need to get, or lead time do you need to get a restaurant reservation in the good places? And so we were just over Easter, we did an Easter brunch. And usually every weeks ahead of time, every freaking Easter brunch place is booked up and you can't even get there. And we always forget to book it. So we're always 2-3 weeks ahead of time and we can't get anywhere because it's always booked. This time, not a problem. We booked 2-3 weeks in, the Four Seasons. Yeah, we're available. Which time do you want? Like, usually it's like, we got one time left, and that's like 2:30 or something like that. Who wants to have brunch at 2:30? But anyway, it's like the last spot. This time, prime time, 11:30, 12 o'clock, everything open, everything available. And when we get there, they actually had less seating than they had in other years, even to start with. And I was like, Now that's the Four Seasons where it's not necessarily inexpensive to go, and where basically the little bit more affluent people go for brunch. And if they're pulling back, then something is in the bushes here. Something is happening right now.
Right.
Yeah,
Right.
I'm with you.
And look, I have a lot of friends in the marketing space. I've got friends in a lot of different categories. None of them are growing right now. Everyone is going, I need bridge debt. Like I have friends in the shoe industry. I have friends in the clothing industry. They're all looking for capital. None of them are not raising money, hiring or trying to grow. It's just not happening.
Yeah.
So I don't know. I would not be surprised that it is not as good as it's being marketed to us.
Yeah, I agree. All right. So how do you prepare for that? What do you do on your end?
Oh, good question. So I would say a couple of things. One, I make decisions personally, and then two, we make decisions for a business. Our business decisions, we always tend to sit on a good amount of cash because we always want cash available for those opportunities. This is one thing I learned in 2007, 2008. Going into it, I full-blown panicked. It was like, I'm looking at all of my friends, I'm looking at my parents, my in-laws, and they're talking about how much money they lost. And it was significant, right? Retirement plans getting cut in half. And I got freaked out. Thank God I had somebody helping me and mentoring me through that time. I called him, and my words were, his name was Randy. Randy, we have to sell. I can't continue to take this loss. We got to sell everything and get out now. And, bless him. He goes, Mikey, we're not selling, we're buying. I'm like, what do you mean we're buying? And he goes, dude, this is the time we prepare for. This is when everything's on sale. This is where you actually take market share. And I was like, I remember thinking, okay, dude, I'm going to trust you, but this doesn't feel good. And then all of a sudden, 2010, 11, I look like a genius, And so I go into it the same way. Like when I start seeing contraction, I want to make sure our business is in a healthy position. We have healthy cash flow to get us basically to a point where we can go after stuff. And then I'm looking at my personal stuff the same way, right? What can put us in a position where we're not able to buy and we're going to potentially have to sell? And whatever those are, I need to take them off the board as fast as possible.
Absolutely. Yeah, and I couldn't agree with you more. We were in a similar blessed situation in 2008. We were 8, 9. We were able to start buying, and we didn't buy enough. We didn't buy big enough. We didn't buy enough quantity. We didn't buy leverage. We just bought cash because their financing wasn't available. And my biggest regret is to not buy 10 times as much. But of course, hindsight is 20/20. But it made sense to buy back then, and it makes sense to buy carefully right now to the right kind of assets. There's a lot of garbage on the market. A lot of people still thinking it's 2021, but there's assets on the market that make absolute sense. Well, great. It was wonderful talking to you. How do people get a hold of you? How can they find out more about you? What's your podcast? What's your other piece of information you can give out for people to get in contact with you or your companies?
Okay, so if you want to get in contact with me, you can go to any platform. I'm Mikey Taylor, and I am fortunately verified and at the top of the list. So you could find me there. Our podcast is called Life with Mikey. We're on all of the platforms, Spotify, Apple, etc. And then my business is Commune Capital. So you can find us on all the social platforms, or you can check us out at communecapital.com.
All right, so thank you very much for being with us. I think it was a great discussion about the marketplace. I learned a lot about, not discarding entire states, because if there's a reason why people run from it, there's actually a reason to actually invest in that state. So it was very enlightening, very cool. Thank you very much. And with that said, everyone, this concludes our podcast. As always, give us the 5-star review. Hit that. If you're watching on YouTube, hit that subscribe button. Share it with your friends. Be an advocate for it, because we know that most people who watch that are actually not yet subscribers. So make sure you subscribe right now. Thank you very much, Mikey.